A very good morning to you. Let's see, have we got anybody on? Good morning. As we come on this beautiful Monday morning, please say hi. Make sure you can hear me and see me. Put something in the comments as we go. I'm going to crack on straight away today because we've got quite a lot to unpack. I haven't been live for a couple of weeks. That's because week before last, there wasn't a lot of announcements. This week, we've had inflation announcement and we've had UK HPI announcement. That's the UK Housing Price Index. So I want to dive into that data today, have a look at what's going on in the UK, which is the, I would say, the gospel of house price indexes, which gives us a true reflection of what's going on in the UK property market. And really analyze that data. But before we do that, what I'd like to do, I'm just going to flick to here, is recap something I spoke about in the live stream 2 weeks ago, which was why are the Halifax and the Nationwide HPIs, why are they diverging? Oh, and hi, I think that's probably Dino coming on. Let's see if I can put, there we go. Oh, look, we can get the comments on. So I wanted to look at why the Halifax versus the Nationwide HPIs were diverging. Now, there's been a lot of chatter on social about this, about what's going on with the property market. Nationwide is saying that the property market has gone through, I think it's now 8 or 9 months of decline, whereas the Halifax has said the last 4 months have been rising. So we've had this big sort of divergence of the two indices. So I've linked to it in the post, in the description of this post, that video, where I went through a deep dive of looking at all the data and trying to understand why they were diverging. And to cut a long story short, the conclusion that I came to was that the Halifax has one key metric that they put into their model for modelling average house prices, which Nationwide does not, and that is the size of a house, so the floor area of a house. So when you follow that through, and go and check out that video if you're into your stats, I followed through the logic behind why this would happen. It shows that, or it would show, that people are effectively going to smaller properties, going from larger to smaller properties, smaller floor area properties, which is boosting the price per square foot or the price per square meter, however you look at it, in smaller properties. Now, I saw this yesterday in, I think it was a Sunday Times or something like that, where the economists seem to actually agree with me. So this article came out, Shift to Cheaper Homes holds answer to diverging UK house prices. So effectively, it's an article that came out from a sort of a prominent economist that went through exactly the same rationale, kind of agreed with the thought process that people's buying behaviors right now, or moving behaviors, are generally, I say generally, this skew is caused by people downsizing or selling larger homes, going to smaller homes. So that demand in the cheaper end of the market, smaller homes, cheaper end of the market, is going up. So the supply demand curve is very, very strong on that lower price point property. Now, when you follow this logic through, it does make sense. We're in a cost of living crisis. We've got interest rates coming up. People are going to be able to afford less. If they can afford less, the natural movement is going to be from larger homes to smaller homes. So a lot of people, probably in the era of cheap money post-COVID, have been going out and buying larger homes, probably stretching themselves a little bit further with what they can afford. That's now reversing, crunching, and people are now reversing that trend, going to smaller homes. Also, there's the post-COVID sort of reversal of people going from inner cities out to the countryside and now coming back into cities. So countryside, bigger properties in the countryside sell smaller properties in cities, kind of reversing that trend. So that's interesting. What does that mean for house prices? It's difficult to tell, but I think without a doubt, what it shows is that, you know, that sort of lower price point, there's a lot more demand than supply. The prices at the higher end of the market are, you know, they're not a free fall or anything like that. I think there's a lot of stubbornness at that end of the market. I think when we look at things like wage growth, which we'll do in a second, there's probably a lot more wage growth in the higher income demographics, which means people are holding on rather than reducing the prices significantly. I think the last Rightmove report showed that actually house prices, asking prices have gone up, but that was mainly driven by the top end of the market, the more expensive properties. So I think that demographic, less motivation to sell. So it's interesting seeing how that follows through. Now, how does that go over the next 3 to 6 months? Interesting to see. At some point, we might see a reversal in that supply demand, and what impact will that have on house prices? I'm not sure. Okay, who have we got on? We got Tiggy. Hello. Is it Tiggy or Tiggy? I had a very good weekend, and I'm absolutely loving the fact that the sun's out and it's very spring-like. So great to see you. Right, so that was the difference between Nationwide and Halifax. Let's now dive into UK HPI, by the way. If you find this data analysis interesting, this sort of breakdown, I try and do it every time a major piece of information comes out, try and look at the data, look at the stats, delve into them, and try and follow the logical steps of what's actually going on rather than just looking at the headlines. Because if you just look at the headlines, mainstream media, and also YouTube, Facebook, if you look at the headlines, it's going to be a confusing picture. I really try and go objective, data-driven, and follow through what's actually happening. So if that's something that you find beneficial, you enjoy, please like the video. I'm on a bit of a quest at the moment to get to 1,000 subscribers. We've only launched the channel 2 months ago. So like, subscribe, and I'll keep you up to date with everything that's going on. And by the way, if you want to see videos about property strategies, just go and check out the channel. There's plenty there. Okay, that's enough of that. Let's go on to UK HPI now. This is the UK Housing Price Index. So, Housing Price Index, UK Housing Price Index lags the other indicators. However, it is the definitive source. So it is all land registry transactions. Because it's land registry transactions rather than mortgage approvals, it's the actual transactions, but it does lag because conveyancing and registering land registry does take time. So we've actually, the data has been released for February, which shows another 1% drop in the UK HPI, House Price Index. So that follows a drop in January. So that's, I believe that's 3 consecutive drops in the UK HPI. And you can see here, and I might just have to come off this and zoom in. Oh, sorry. So you can actually see what's going on because it's not the greatest graph in the world. It looks like we've hit that peak and are coming down the other side. Now, don't forget, I said this lags a lot. I think what's more interesting to look at are these 2 graphs below, which is the year-on-year change. So this one here is the year-on-year change. And we're still plus 5% year-on-year. So if you're looking February 23 to February 22, still up. But you can start to see this line is now definitively coming down, which is matching what both Nationwide and Halifax are saying. And again, most interesting to me is the month-on-month. Now, if I just zoom out, I've kind of gone back to the financial crisis of 2008. Okay, if we look at month on month, generally we're in a bit of a range from sort of 2010 onwards. We've got this massive spike here. Now, this spike is a big skewing of data due to the, if you remember, the stamp duty holiday that came in post-COVID. This was the stamp duty holiday ending, which caused a massive rush of completions before that stamp duty holiday came in, and then obviously a sort of, I guess, a lack of completion straight after. So we've got a big data skew. So I want you to kind of ignore this massive sort of tick up and tick down, but look at the range. So month on month, we've now got a line that's in quite a consistent decline, and we probably haven't seen that since the financial crisis of 2007, 2008. All right. So we're actually at the lowest point month to month if we take away that big spike since the financial crisis. So this is something we're going to have to watch carefully and just see how it pans out over the next few months. And the reason we need to see how it pans out over the next few months is because it lags so much. So property is glacial and it does lag an awful lot. What I've actually done is I've gone back further on this, and I wanted to look at the annual change since sort of 1990. Now, if anybody follows house prices for that sort of time period, you might remember that in the late 80s there was a massive surge up in house prices, and then the 90s saw a pretty large decline for a long time period. And then the next decline we had was the financial crisis of 2008, and I've kind of highlighted both of these on this graph because I suspect that what we are seeing is a house price correction that's more akin to the correction of the 90s. Okay, and I suspect, because I don't know, we have no idea where things are going to go. We can't say for certainty. What we can look at is probabilities of different scenarios. And at the end of this live, I'm going to go through what I think are probably the 3 scenarios that most people are looking at and talk about the probabilities of those and what I think is the highest probability. So if you look at the 90s, okay, we had house prices actually negative growth for 3.5 years, 3.5 years worth of solid house price falls. And if you look at both the nominal and the real house prices, that was a significant drop. In 2008, it was a much shorter, sharper crash. Okay, so I would say an actual crash rather than a sustained correction. And we had house prices going down for 1.5 years. So, a big difference in time period. Now, of course, the financial crash of 2008 was triggered by an event. It was triggered by the credit crunch. I did a video on it a couple of weeks ago. Go and have a look at that, to look at how the banking system works. It was effectively triggered by all of that lending drying up. Okay, so it was a black swan event, if you like, that caused that short, sharp crash. 90s, big housing price boom followed by very high interest rates led to a sustained house price reduction. I would say if you look at the scenario right now, we're probably more similar to the 90s, where we've had a big surge in house prices, and we've now got interest rates going up fairly rapidly. And there's still people talking about the difference in the 90s between interest rates at 12, 13, 14, 15% versus now 4.5%, 5%. The difference is the value or the amount of debt people have in relation to their income. Okay, so we now have much higher debt levels compared to our income, and property prices have gone up a lot more compared to income, and therefore small amounts of interest rate raises will have the same effect as larger ones back in the 90s. So my gut feeling, okay, if we look at predictions and probabilities, is that we're more akin to the 90s. What do you guys think? Who's watching right now? Let me know what your thoughts are. And by the way, I still see on social media the property bulls with an internalisation that property prices are only going to go up, still saying it's just a little blip. Look, Halifax has proven that actually market's going up. The rationale that people are using is that because Halifax is the larger of the two, between Halifax and Nationwide on the HPIs, that Halifax is more reliable. It's effectively the whole Lloyd's banking group. Now, it is bigger, but not hugely when you compare it to UK HPI. And so therefore they say, because the Halifax is going up, property markets resumes going up. I'll look at some figures of why I think that is incorrect over the next few slides. But what do you think? Let me know. Put it in the comments what you consider the market is doing. Do you think we're a little blip going up? Do you think we're going to be a massive crash, more like 2008? Or do you think we're going to be more sustained correction like 1990? Or something completely different? There's many probabilities and scenarios out there. Let me know. And I'll whack those comments on. Okay, so I want to crunch where we are with the UK HPI versus Halifax and the Nationwide. The reason I want to crunch this is, as I said, there's a big lag in UK HPI. So it's not fair to compare the UK HPI figures now to the Halifax and the Nationwide figures now to kind of get an idea of what's going on. Now, if we look at HPI, this is, on this slide, I've got UK HPI for February on the top. I've then got Nationwide for November, and I've then got Halifax for last year going to November. And the reason I've chosen November is because both Nationwide and Halifax peaked in August, and UK HPI peaked in November. So it's completely crude, but from my point of view, there's a August, September, October, there's a 3 month difference. So UK HPI peaked 3 months after Halifax and Nationwide. So I'm looking effectively at that difference in 3 months to try and compare them. And if we look at the difference in 3 months from peak to where we are now, okay, takes us to November 22 with the Halifax and the Nationwide, right? So we've dropped by 1% UK HPI. The Nationwide at this point, or 3 months post-peak, was showing 1.4% negative change, and Halifax was showing minus 2.4%. So actually, Halifax and Nationwide, 3 months after peak, were showing a much higher decline or a higher drop. But the annual change was still up on both the Nationwide and the Halifax. So respectively, we've got 4.4 and 4.6, and UK HPI is 5.5. So we're kind of in lockstep at the moment. So the fact that UK HPI has dropped by 1%, I think, is no surprise. Actually, it might even be less than some people thought, which could be positive. I don't think we're going to get a good idea of what's going on until we get 3 months down the line. So that point where where Nationwide and Halifax diverges, I'm interested to see what happens with the UK HPI at that point, because I think that's going to give us a better indication of what's been going on. They're all in lag. If we follow it through, so they started diverging in January, which means we've got another 2 months, so February, March, April. So April onwards, data from UK HPI, I think is going to give us a much better idea of where we are in the market. So I'm going to look at that. Lek, how you doing? Let's see some movement in Cornwall. More properties come up on the market, and a few Yeah, so Lex saying he's seeing more properties come up. The live I did a couple of weeks ago, we showed the percentage of properties that are listed that have had price changes, or the percentage of properties that have sold that have had price reductions, and it was the highest that we've seen in years and years and years and years. That shows to me that sellers are becoming more realistic. I'm not saying it's crashing and they're fire selling, but they're becoming more realistic and dropping their prices to something that's more realistic to sell. One of the big arguments that's propping the property market up, because I know a lot of people are going, look, this is just a little blip, we're a couple of percent down, who cares, we're going to go back up. The property bears are going, this is more stubborn than we thought. I think we've still got that supply and demand issue there, that there's just not enough supply to trigger, a full-on crash. If that changes, if a big supply changes, I think that will see nominal house price reductions accelerate. I'm talking about nominal, which is the sticker price, not real, which is inflation adjusted. Inflation adjusted, we are down double digits already, and I think that is pertinent. Okay, great. Cheers for that, Alec. Right, so let's look at some of the other factors that are coming into play to try and analyse what's going to go on over the next few months. And by the way, don't forget, the reason that I always do this and I go through this data is not to say, oh my gosh, there's going to be a massive crash going on. Okay, it's not to say property is just going to go up in a straight line from here, it's going to be awesome. I want to be able, I want to put out what people can use to make informed decisions, right? Specifically, as property investors or developers, we want to be able to use that crystal ball to look at what's happening over the next 6, 12, 18 months for any projects that we're in, to understand what offers to put in, how to price things, what it's going to cost to convert, what's our risk tolerance. If we're developing now, what prices do we want to do our deal appraisals at, right? If we're buying to invest now and we're going to hold for 30 years, does it even matter, etc., etc., right? That's the reason that I do these, so you can make informed decisions. Right, we know, or well, I say we know, I assume, you probably saw the headlines that inflation is sitting high, stubbornly high, right? And March was still up at 10.1%, so still over 10%. This is a big thing, I think, and I don't feel it's any surprise. The theory behind the analyst or the economist thinking it's going to drop more is that one of the things that triggered this huge inflation growth loss, and don't forget, we're looking back year on year, so we're looking compared to now between March 22, was the surge in energy costs, end of 21, beginning of 22, invasion of Ukraine, all of that sort of stuff. They're now sort of falling out. If you look at the year trailing data, they're going to be falling out of the data set probably now, really, and that's where the expectation is that inflation is going to come down quite a lot. These price rises happened a year and a bit ago, they're going to be falling out of that data set. However, the soaring cost of energy has kind of been replaced by the soaring cost of other stuff. And the thing that's really taken people by surprise is things like food inflation, potentially even wage inflation. Now, I actually spoke about, I put a post out end of 2021. Being a landlord myself with a portfolio where I pay a lot of utilities, we've got service accommodation, we've got HMOs. The first time this sort of cost of living crisis really came to me was November 21, when some of my HMO utility contracts came up, and the price I was renewing on took me a little bit by surprise. Now, actually, I refixed those for 2 years, so they're about to, this winter, they're going to come up for renewal again, which is a great thing, because obviously in 22 they went up a lot. But I started to sort of pay attention with this cost of living crisis that was evolving. And I remember seeing some articles at the end of 21 about fertilizer prices. And those fertilizer prices are driven by the energy market, because we need energy to create fertilizer. And if we have a look at this graph, you can see how sort of mid-21, a lot of the cost of fertilizer started spiking. And I remember seeing an article at the end of 21 about how this is going to affect food prices over the next 12, 24, 36 months. And I feel we're seeing two things now. We're seeing the effects of that, and this is obviously continued last year. It's starting to come down now, but everything has a lag in the system. So we're starting to see the effect of that with food inflation. But we're also starting to see this greed inflation, okay, where because this inflation figure gets sort of baked into our psyche, retailers, wholesalers, whatever, are just adding margin upon margin, because they go, oh, people are expecting price increases with inflation, so they'll just put the price up anyway to increase their margins. Look at the utility companies. Ultimately, if the utility companies are only putting their price up in line with the cost of wholesale gas, electricity, then they're not going to be making all these record profits. So the fact they're making record profits means they're putting margin upon margin upon margin and just increasing their costs more than they increase their cost base. Sorry, increasing their prices more than their cost base increasing to make more profits. Okay, so that's how inflation kind of gets set in. And I do feel that we're in that cycle right now. As well as property, I think if you've been following my stuff, you'll know that I also buy and sell businesses. A group I've been building over the last couple of years is a scaffold group. The cost of commodities, steel, timber in that in 21, 22 absolutely skyrocketed. Because of that, we had to put our prices up. We've now got wage inflation, so our operatives are expecting, and quite rightly, they need it to be able to live higher wages. Wages go up, we have to put our price up, and everything starts spiraling. It becomes a self-fulfilling prophecy. So it's interesting looking at how this inflation is panning out, and it's certainly not dropping nearly as quickly as people think. And I think ultimately we don't know what's going on. As I was researching this live yesterday, I found this article, which is 4th of November 2021. It's a BBC article, 4th of November 2021. Okay, Bank of England hints at future interest rate rises. So this was when interest rates were still at 0.1%. And the article says inflation expected to peak at 5% next April. Okay, that's April 22. The governor of the Bank of England stated, for the foreseeable future, we're in a world of low interest rates. It doesn't mean that they don't rise and fall within that sort of bound, but I want to be quite clear, we're not signalling there's going to be some very sharp return to the world that we just about remember before the financial crisis. That's Mr. Bailey, Governor of the Bank of England. Okay, so the point I'm making with this is we can hypothesize, we can predict, we can look at probabilities as much as we want, but ultimately, fundamentally, nobody knows exactly what's going to happen. Everything is quite reactive. Now, we've seen, right, this inflation still above 10% in March 23. Everybody's now talking about what's going to go on with interest rates for the rest of this year, okay? And that's been revised. So let's have a look at interest rates. By the way, what's your thoughts? Any thoughts on that? There you go. Sorry, I'm just seeing from, I think it's probably Dino, slow correction, but people are in denial about the fall in prices. I think they are. So let's look at interest rates, because I still believe this is the biggest factor that's going to weigh down on the property market over the next 12 to 18 months. Okay, the biggest factor. So where are we right now? Right now we're at 4.25%. A lot of people were saying that's going to be the end of it. So even a week or so ago, a lot of people saying that's going to be the end of it. 4.25% is the top. It'll probably stay there for a few months to start coming down with inflation. We're now talking about people are at the worst end of the spectrum, talking about 5%. So another 0.75% this year. That's kind of worst case. The majority are saying we're definitely next month going to go up to 4.5, and maybe another one 4.75, but 4.5 certainly, and then it's going to stay higher for longer. Now look, this is going to put strain on everybody. The longer interest rates stay high and people are coming off cheap fixed rate debt, the more of an affordability issue this is going to cause for people. We'll talk about affordability in a sec. I just want to show you the SONIA swap rate. If anybody understands how fixed rate mortgages are priced, it's not on the base rate, it's on the SONIA swap rate. So SONIA swap rate is a forward-looking metric. So I'm looking at the 5-year, which I think we use five-year mortgages as a good sort of way of comparing things. Currently, SONIA swap rate 3.939%. I say currently, this was I think yesterday. Or the end of Friday. 21st of March, so a month ago, is 3.565. So we've gone up 0.4% since that inflation figure came out. So basically, the market is pricing in higher interest rates, okay, for a longer period of time. Just to put it in context, after the mini budget, I think it nudged above 4%. It sort of declined down to sort of base bottom 3%, and then it's kind of been meaning around 3.5%, but it's definitely climbed up again. So the market is pricing in higher interest rates for longer at the moment. And I stress at the moment because we have no idea of future policy and trend reversal events that can happen at any point. Okay, we can talk about that at the end. So what does that mean? What does that mean for the property market? Let's just go, in fact, we'll talk about affordability in a bit. I think interest rates are going to go up. we're talking about rise, or media is talking about rise in loan defaults, as in people not paying mortgages, being in arrears. One of the big things that could have been a black swan event is another credit crunch. Now, if you remember 2008, I talked about this, that short, sharp, but massive drop in house prices caused by the credit crunch, which is basically the bank stopping lending. I put a video out a couple of weeks ago about, is there going to potentially be another credit crunch, which is banks tightening up on their credit. When we started to look at the banking crisis, Silicon Valley Bank, Credit Suisse, a lot of rumblings about banks tightening up their lending. And I think that's still going to happen. So there was a survey done, it's slightly out of date, but a survey which looked at how lending was going to go in Q1, Q2 and further. And the results of the survey were people expecting credit to tighten in Q2 2023. This was before, or the survey was kind of done at the same time period that Silicon Valley Bank was getting into trouble. So this might now be out of date information. Consensus is banks are going to be tightening on their criteria, lending criteria, because of interest rates going up and because of affordability. Okay, so one of the big arguments for the property market not crashing is how much more stress testing is done on people's incomes than it was, 2008 when there was no stress testing. And of course, that has put people in a better position to service their debt. But we've now got this spiraling cost of living, which just is not going away. And that is probably expected to tighten the lending market even further. And just to kind of follow through on the logic of this, tighter lending market, right? Higher interest rates, tighter lending market means people can borrow less. House prices are driven by what people can borrow. It's just maths, right? If people can borrow less because interest rates are higher and their affordability is tighter, right? Let's talk about wage growth in a sec. Let's just assume people have less excess income because of, the utilities are higher, food's higher, and mortgage interest is going up, so they can borrow less, right? Can just borrow less and therefore can buy less. So it's maths. Prices have to come down, which is what we're seeing right now. So let's talk about affordability. Any more thoughts, by the way, about interest rates? Let's have a quick straw poll, actually. I would love to see, we've got plenty of people on the live, and if you're watching this afterwards on the comments, please put down where you think interest rates are going to top out and for how long. I'd be fascinated. I know we have a knowledgeable viewer base on this channel with property. I'd be fascinated what you think will be the top of the interest rates and when and how long until they start coming down again. I would obviously like them to come down. I always hedge my interest rates, by the way, my mortgages. So I've got some on fixed. In fact, I was lucky enough to refinance a big chunk of my portfolio with Lloyds at the end of 2020 on a 5-year product, which is, I think it's about 3.1% fixed for 5 years, which is great. That comes to an end of 2025, so 2.5 years. I also in 21 bought a business with commercial finance, which was a variable rate, so I could only get a variable rate on that particular product. It was property within a limited company. That is currently sitting above 10% interest rate. That's really hurting. Luckily, because it's a larger property, higher density, I always talk about looking at mixed use, higher density, and then lease them out so you have predictability in income. The margin's so fat on that, it's still making good profit. It's just, eroded that income quite a lot. So let me know your thoughts on where you think interest rates are going. Okay, while you're doing that, let's talk about affordability, because again, this is another big factor. So we've got mixed signals right now in the in this part. So we have seen a slight tick up in unemployment. It's not massive, right? We've gone from 3.7 to 3.8%. There's a slight tick up. I do always think that unemployment figures are slightly skewed because I know government would like to manipulate data. So within that, I don't know how many people who are working just a few hours on zero contract hours, for example, are classed as employed. It has ticked up, and the amount of vacancies, I think it's the amount of vacancies in the country or the UK has dropped by 48,000, which is quite a considerable drop. Now, this is interesting. So when we look at the wider economy, house prices and the economy are going to be related. House prices are not just about interest rates and affordability, right? If we go into recession, if we start to see lots of people made redundant, unemployment spikes up, okay, that's clearly going to have an impact on the property market as well. So I feel we're kind of, from a business point of view, not a property point of view, as a business owner myself, kind of teetering a little bit, and it won't take much to kind of push it over the edge. And especially with interest rates continuing to go up, how's that going to slow the economy further and affect businesses? And if businesses start making a lot more redundancies, look over the last couple of months, you've seen a lot of big tech, Google, Facebook making big redundancies. How is that going to then filter in? So anyway, unemployment, slight tick up, but pay growth goes up. Now, pay growth is an interesting one because at the moment, it's the biggest argument the property bulls have about house prices continuing to go up. So wage growth go up, people can afford more, house prices can continue to go up. However, wage growth in nominal terms, i.e. what people are actually taking, is going up. I think we're about 6.5%. We're over 6% in the last set of data. But real wages, if you look at this chart, just look at the red graph for real and look at the sort of the black and the blue for nominal. Real wages are in negative territory, i.e. inflation adjusted. So because inflation is so high, even though people's wages are going up, their actual purchasing power is going down, which for me is a negative impact on affordability, right? It's not suddenly that we've got loads more money to splash around. So right now we are seeing wage constriction. Now, if inflation falls off very dramatically, which it can do, there is a scenario where we can overshoot this inflation thing. We're going too aggressive on the interest rates, and then inflation just drops off nothing, and all of a sudden, wages are still going up. There'll probably be a lag in that. We could suddenly find ourselves with a lot more affordability. However, let's just see how that data pans out. I think the reason I want to talk about wage growth is when people talk about, there's lots of wage growth, 6.5% rate wage growth, everything's great. However, just you look at the news and you look at the amount of people striking about pay, and I think the reality is not quite the same as those headline figures of everything's rosy because we've got high wage growth. This is just a screenshot of a calendar, a website with a calendar of strike action, and it's almost every single day going forward, there's strikes somewhere. I would love to see, if I go back to this wage growth, I would love to see wage growth in terms of income bracket, because I have absolutely no data to back this up, but I just have a gut feeling that the majority of the wage growth is going to be in higher income demographics. So the lower income demographics are going to be struggling, as always, rich get richer, poor get poorer. I think there's probably going to be a big split. I can't back that up and prove it, which again filters through to people with large houses, not being stubborn, not dropping the prices, whereas people who are struggling a little bit are now downsizing. Is my gut feeling that we're seeing a widening in that wealth gap in this country. Nothing to back that up, but if we have a big percentage of lower income bracket demographics really struggling, okay, that's in terms of numerical people, that's going to be the biggest demographic. How's that going to filter through over the next sort of 12, 18, 24 months, and how's that going to affect the property market? Just something to think about. And finally, on affordability, this is a graph that I got from the Nationwide Affordability Report, which they do quarterly, which shows this is first-time buyer mortgage payments percentage of take-home pay. You can see how those have spiked over the last couple of years. Now, the red dot at the end there kind of shows where we'll be if mortgage rates go up to 5.5%. So if interest rates do go up next month, which I think they will, and continue to go up, we're going to be hitting there in the not too distant future. As a percentage, that is going to be pretty much the same as when we hit the crash in 2008. And not far off where we hit the peak in 1990. So I think that's quite a scary demographic. Now, I did see on social, if anybody follows other people on Facebook, Rod Turner, extremely knowledgeable, well-informed person, who said this is now out of date, and they've Nationwide's revised these figures down. I don't know why they would do, but they've revised the figures down for Q4 2022. I've not seen that. This is what's on Nationwide's website at the moment, so I look forward to the next report, and if they're revising it down, we'll talk about that. So there potentially is a bit of a skew in data here somewhere, and Nationwide have revised it down. But the point is, you can see, just on a macro level, okay, affordability is compressing. Is that the last? Last slide for affordability. Look, here's the forecast of mortgages in arrears and property repossessions. So the forecast is the trend is reversed. The trend's been down since the financial crash, which is kind of probably obvious. Era of cheap debt. I don't think it takes a rocket scientist to work out it's going to reverse. The question is, how quickly does it reverse? How many issues do we have in terms of people struggling to pay their mortgage and repossessions? Again, the live I did 3 weeks ago, I looked at the data set, the detailed breakdown of mortgage arrears and repossessions, where we saw a marked increase in the buy-to-let sector with arrears and a slight increase in home ownership, just tipping into arrears. The problem with that data is it only starts when you're 2.5% of your arrears are 2.5% or more of your mortgage, which is roughly, if you've got a full mortgage, 25-year mortgage, I think it was 4.5 or 5 months worth of arrears. So it'll be interesting to see next quarter how that trend goes. Right, what we got? So we got LEC. LEC reckons 4.75 by the end of the year, and then down again. Yeah, LEC, I've got to be honest, I can't see 5% with no external forces at play. And I always say that, right, trends, we're in a trend. Interest rates up, property price down, that trend is there. There could be something, an external factor that nobody forecasts, black swan event, that causes a crash, right? Like a horrific crash, because I think things are fragile right now. It's like, that deck of cards or those foundations, we're still there, but it's wobbling, and all it needs is something to come and push it over, and the whole thing could push over. On the flip side, you could have a change or an external event that actually reverses everything. Let's say, for example, election time in the UK, which I think is next year or beginning of 2025, right? Things are too bad. Do government want to change policy? Okay. Do we, for example, and I'm going to do a video on this in a few weeks' time, because there are people in the monetary MPC, the people who do the interest rates, okay, who think that we're going too quickly with interest rate rises and we're going to overshoot it massively. It's because there's so much lag in the system. It's like trying to steer, sort of a massive oil tanker, through the, on an ocean, where you put an input in, and the front starts moving, and you can't see what's going on. And if you overcook it, right, it turns too much, and then it takes a horrible time to reverse it. There's an argument that we're going to do the same with interest rates, that we're going to go too far, too high, and that we're massively going to overshoot the inflation target. And when all these factors drop out, it's going to go into deflation. Now, that would see a reversal in government policy. So we could go, we're in quantitative tightening right now, i.e. taking money out. That could be reversed. We start pumping money back in, and interest rates could go very low again. And then we've got this massive pent-up demand that would see prices skyrocket. So when I talk about probabilities, there's probabilities of both. We'll talk about all of those scenarios in a bit. Lovely. Any other thoughts on interest rates, team? This I just found this. I thought it was interesting when I was doing research for this. There's an article I saw. Okay, I'm just going to read this. Angry homeowners sold cheapest mortgages in history. Consider legal action. I mean, this is amazing. So, effectively saying people who went in sort of in 2021, when they went on the super cheap 2-year fixes, they're taking legal action against their brokers for advising them to take those fixes. Now those fixes have expired, and they're going on to these much higher either standard variable rates. By the way, standard variable rates are 6-7% right now. That's eye-watering. So if somebody has come off a fixed, if they've really stretched themselves in 21 on a 1.5-2% interest rate, okay, and then they've come off, and let's say maybe they've lost a job, or their wages are down and affordability's hit, and they can't refinance, okay, and they've gone on to a standard variable rate, and they've gone from 1.5-2% to 6-7%. That's a huge increase, right? That's a massive increase in terms of mortgage payments. And there's this interesting thing about homeowners suing brokers for advising them not to go onto 5-year fixes, which I think is interesting. So just look at the breadcrumbs, look at what's going on, right? I try and look at the media, see the articles, and try and read between the lines and look at the trends that are going on. There we go. Right, conclusions. Let's try and draw some conclusions here. Just give me a sec while I change. I talk about probability, okay, and if we look at the housing market, this is where we are right now. Okay, nobody can argue we are, peaked and we're coming down. I would say really we've got three main probabilities, of what's going to happen. We're just in a little dip, okay, for whatever reason, and the property market is going to, resume where it goes pretty quickly. We're going to see a massive 2008 crisis where it's going to dip horrifically and then start its way back up again. Or we go to a more 90s style, slower, shallower correction before resuming upward. Now I say on all of those, you probably can't see that white very well. Let me change that. Right, I'll put that to blue. Right, by the way, just because the original one is blue and that one's blue does not mean I think that's the most likely probability, although I do think it's the most likely probability. I put on that graph all of them resuming upwards we always think that the UK property market is going to continue upwards, and I think on the balance of probability, I would agree with that. When we look at supply-demand issues, when we look at house building, all of that sort of stuff, I think long-term we're always going to go up. It's not a given. It's not a 100% probability. I think it's a high probability that whatever happens, we will resume going up. My gut feeling, right, is this blue line is the most likely probability. So it'll be a longer, shallower correction. But if you look at the 90s, there to there was 3.5 years. I've got no idea how long this will take. I suspect it's going to go into 2024, but we'll wait and see. An external event could trigger this: credit crunch, something else that caused inflation to go up, interest rates, whatever. I don't think it's that likely, but it is possible. I think this is the least likely one. That from here we're back in the upwards from now, based on what Halifax are saying. But it is probable. Okay, there is a probability. So that's my thoughts about where we are with the housing market. By the way, this graph I feel is nominal house prices, so what we're actually paying. I do think that when we adjust it for inflation, right, it is going to be deeper and longer. Unless that inflation rockets down very quickly, which it could well do. Okay, it's going to come down at some point. It just has to. Don't forget, inflation coming down. I'm just going to go back here. Inflation coming down does not mean that things are getting cheaper. It means things are getting more expensive at a slower rate. So, the media goes, inflation's coming down. It's great. If inflation goes down, I think the economists predicted 9.6 or 9.8% for this month. We're 10.1. If we'd hit 9.8, which is what people predicted, would everybody have been high-fiving, going, this is great, we've got inflation under control? No, everything's still going up at 9.8%. So, yeah, it means things are still going up, just at a slower rate. So we need to get that inflation down. There we go. There is my current analysis of the UK housing market. I hope that was useful. I'm very happy to go on to Q&A. What time is it? 9:42. I'm happy to stay and answer questions. If anybody has any questions about anything on the channel at all, anything about UK property or your strategies, I will crack over to you. Lex says, hope they don't overcook it. Yeah, I suspect. My gut feeling about what we do in this country is we always are in some form of denial about what's going on. I mean, talking about, politicians, policymakers, and we generally go too late and then do overshoot it. So when I was in the Air Force flying airplanes, we had this phenomena called PIO, which was pilot-induced oscillation. And it's exactly that. It's basically when you're flying an aircraft, if you put a control input in that's too much, you overshoot where you want to go. And then, let's say you want to go down, you push the stick down and you go down, but you put too much input in and you go down too much and you go, I've got to pull it up. And you end up doing this. It's called PIO. Now, generally, it's not just flying in normal conditions. It's what certain types of condition that you're fighting, like turbulence, stuff like that, or whatever. But you kind of see the same, I think, with economic policy, is that things oscillate. Probably, you want them to oscillate as little as possible around a mean, but inevitably, kind of end up like doing that. And I just feel that's what's going on at the moment. Is that again, I've got nothing to back that up. It's just a gut feeling looking at my property portfolio. Interest rates on my variable rate lending, it's painful, right? And I'm not going to say, hey, look, this is great. I've got loads of cash flow and loads of fat in the system. There is fat in the margins, but getting those margins eroded is always going to be painful. So when people come on social and go, oh, my portfolio is really cool, it's not affected by this sort of stuff because I make so much money. Rubbish, right? If your profit's getting eroded, it doesn't matter. If you're still making profit, it getting eroded. You're still making less, right? That's harmful to people. And if you've got a really well geared portfolio, or geared for the current circumstance, brilliant. But a lot of people don't. A lot of people are really struggling. Okay, a lot of people in when you look at tax changes, Section 24, all of that sort of stuff, really painful. Which is why we're losing so many buy-to-let landlords at the moment. Okay, any more team before we wrap up for the day? I hope that was useful. Give me a big nice thumbs up or a comment if you think that was good. If you think it's a load of rubbish, you are more than entitled to put a thumbs down. I'm sure we'll get a couple of people, the usual suspects, who think anything other than a message that the property market goes up in a straight line the whole time. We'll come put some thumbs down. But I always appreciate any sort of likes or comments on the videos so we can get it to more people. Let's just see what you got. Too slow. I've got Dino's thanks instead. Waiting and preparing for that small dip. Yeah. I still think we're going to see better opportunities in the next 12 months than now. Doesn't mean I'm not buying now. I think we're going to see better opportunities, which is exactly why I sold my house last summer and went into cash to take advantage of those opportunities. But we'll talk about that for another day. Okay, amazing. Team, I'm going to sign off. I will see you probably next week on a next live or the week after. And I'm sure we'll have a lot to chat about after the next base rate announcement. But in the meantime, to your own success, and I look forward to seeing you very soon.